Well, good day, everybody, and thank you for joining us. Uh, as usual, we'll be doing our quarterly update on REIT performance, and this time it'll be for the first quarter of 2026. My name is Mike Consol. I'm editor of Real Assets Advisor magazine, one of six titles published by Institutional Real Estate Incorporated, which is co-producing this event along with Nareit, the National Association of Real Estate Investment Trusts. Nareit is being represented, per usual, by John Worth, Executive Vice President of Research and Investor Outreach for the organization. Also joining the discussion is Eric Rothman, Portfolio Manager at CenterSquare Investment Management. Audience members, as we do at each of these webinars, we invite your questions and we will integrate your questions into my questions along the way for our panelists. So feel free to go ahead and pose some questions. And I'll only be using your first name, not your full name. So if you don't want to be revealed, no problem. Unless your first name is something like Sting or Madonna, in which case I won't use your name at all. But we'll get your question out there and answer it as expeditiously as possible. Normally, we have more questions than we have time to answer, but we certainly do get to quite a few of them. Also worth noting is that the recording of this webinar will be sent to all of you who have registered, and the webinar will be published on both the IREI as an Institutional Real Estate Incorporated and the Real Assets Advisor websites. John Worth and Eric Rothman, welcome to the both of you. And John, I'm going to begin with you. As usual, we want that snapshot of how REITs performed during first quarter 2026. What do you got, John?
Absolutely, and great to be back with you one more time, uh, Mike. And yeah, you probably let the cat out of the bag that Madonna is a regular participant in these, but she doesn't ask that many questions, so that's fine. The so yeah, so
All
I'll
about the
share.
company you keep, John.
That's right. That's right. Uh, the the um, just thinking about how many Madonna songs I could probably sing you in their entirety off the top of my head because of MTV and my age. But yeah, so the quarter 3.8% year to date returns as of the end of Q1, which is actually pretty good performance when you think back to last year with roughly 2.8% total returns for the full year to date for the full year of 2025. But that the quarterly number really doesn't tell the story. We had some pretty dramatic swings within the quarter. We had a strong January and February with REIT index up 2.8% and 7.5% respectively. But then, of course, as we entered into a period of sort of geopolitical turbulence with the conflict in Iran, we saw a real reversion, both in terms of REIT returns, and obviously that was reflected in broader equities as well. So this chart, you could see the year-to-date return. You could see the returns on by sector for the first 2 months of the year, really through February 27th, and then for March alone, with all equity REITs being up 10.5% as of the end of February, and then falling 6.1% in March. Through today, REITs have recovered a bit in April so far. They're up about 2 percentage points in April. So as we stand today, REITs are up about 5.8% and outpacing broader equities by about 9 percentage points. So REIT performance, I think, has been pretty robust, especially given the environment. But as you could see, it's really been a tale of two periods where for the first 2 months of the year, we only had one sector with negative returns. That was office, down nearly 12%. And we'll talk through some of what's been driving off office this year, with data centers leading the pack at plus 22%. But during March, we only had one sector, data centers, that slightly eked out positive performance, whereas the rest of the sectors were negative. When we put that all together, we see that we really have still what is a pretty good start to the year. The broader index up 3.8%. As I mentioned, we're continuing to see this recover in April, with data centers being the best performing sector, up almost 24%. Specialty, the second, but still driven by data center returns of a constituent who sat in specialty till quite recently. With retail showing a nice recovery in for the year, self-storage showing a nice recovery, healthcare continuing its very strong performance from last year. Um, and then, when we look down to the bottom of the table, we see office down more than 16%, residential struggling down a little bit more than 6% for, I think, a variety of different reasons within the residential sector, ranging from some policy concerns in single family rental through concerns about supply demand conditions in apartments, and telecom, which had a strong start to the year, down 4.5%. And so I think and we'll get into what the crisis and the conflict in Iran means for REIT performance more broadly. But clearly, as we can see, it's really coloring where we stand today. And I think as we're thinking about the market, it's really very much a question of, are we going to return to the path that we were on for the first 2 months of the year, or has the conflict and the associated macro impacts, is that going to send us on a different path for the rest of the year? So let me stop sharing there, and we'll jump into the Q&A.
Eric Rothman, did you want to comment on anything you've seen there?
Um, Not specifically. I think John did a really nice job of kind of rehashing the first quarter and kind of what we're seeing so far. I think the REITs set up well here, and maybe the fact that they have outperformed the broad market as much as they have year to date speaks to a lot of things. Certainly, the value of diversification in times of uncertainty and their durability of income and predictability of earnings.
All right, Eric. Well, let's go to the big story dominating the news that was just um, brushed up upon by John, and that is, of course, the war in Iran and the way it's driving up energy costs. Right now, we are waiting for 8 p.m. tonight, Eastern time, when if President Trump doesn't get some kind of agreement or some kind of serious negotiation, the bombing begins. Things are going to get even worse, it looks like. What will Even regardless of that, we have elevated energy prices. What will the impact of higher energy costs be on REITs? You have some
Yeah,
insights on that?
for sure. We can talk about by sector, by geography, and so forth. So this is clearly the question of the day. Thankfully, there's very little direct impact on landlords. And that is because most of that energy expense is passed through to tenants. Net leases help insulate the landlord from a lot of these situations. In situations where there's a gross lease, or maybe you have a situation where the landlord is reimbursed or charges the tenant afterwards. Think of like a retail asset where there's common area maintenance and so forth charges. There's a little bit of a lag, but in general, those higher costs are borne not by the landlord, but rather by the tenant. In those instances where the landlord picks up more of it, I'm thinking things like hotels, for example, right? If you remember back a number of years ago when we had a surge in energy prices, if you looked really closely at your bill after all the little taxes, there was an energy surcharge. I would not at all be surprised to see that sort of thing come back. So thankfully, the direct impact is somewhat limited, but there's lots of secondary impacts, of course. We think about the potential for higher inflation, potential for therefore then higher interest rates. That's probably the most important, primary, secondary impact. My view is that higher energy prices, to the extent that they are sustained, will act like a tax on the economy, or brake on the economy. And rather than accelerate inflation, while they do across the broad set of inputs, the bigger impact will be a slowing economic growth. That should create kind of a headwind against higher inflation. So while we might see a jump in inflation kind of in the very immediate period, the impact of slower economic growth should offset that. Clearly, the expectations that the Fed would be able to cut rates sooner have really kind of faded from the market. I wouldn't expect that to change anytime soon. They're going to need to be patient. They're going to need to kind of wait, as will central banks around the world. But I think that rates are probably likely more in a holding pattern here for a little bit longer. So if one was expecting immediately lower interest rates, that's most likely off the table. But I also don't think interest rates, absent some unforeseen thing, are likely to rise greatly. The other thing that it does, there's a lot of petrochemicals that are used in building materials and so forth. Think about rooftops and membranes and blacktop and so forth. So this will increase replacement costs. It will increase construction costs, and that, while small, ultimately accrues to the benefit of owners of existing assets, particularly those who are facing threat from new supply or new competition being added. So.
Right.
Yeah.
Yeah,
and then
okay.
from
Thank you,
a
Eric.
geographic standpoint, if you're interested.
Go ahead.
Yeah, what I would say is, fortunately here in the U.S., we're energy exporters now. So this problem is more acute for Japan, for South Korea, Taiwan, that are big importers, particularly of Gulf oil, and then of course UK and Europe, more so than it is here. So as we kind of look across the globe, Canada and the U.S. are in a little bit better position from an energy standpoint today.
Yeah. Points have been made that we're better insulated, and Canada's better insulated than a lot of countries. Not that we're not going to get hit by it as well, but it's at least a muted impact. So we have a question from Michael from our audience, John, and he's saying office REITs are obviously doing terrible or did terribly in Q1, but is this across the board, or do you see areas of strength?
Yeah, I think that and I've been invite Eric into this conversation as well, because I think what's going on with office REITs is really quite an interesting dynamic where and it's not entirely across the board. There are a few glimmers of green on the screen in the office space, but it's been there's very few, I would say. It's been quite widespread in terms of when we look at year-to-date returns. And a lot of what drove that, because, and it stands in contrast to what we're actually seeing, it's of actually, stabilizing to improving operating performance, and in some metros, very, very strong operating performance. I'd say, New York City really stands out, where REITs own a lot of very high quality real estate that is basically on the verge of being fully occupied, as that quality divide we've talked about many times really continues to play out. And so REITs really, and the office REITs really ended up, I think, in some ways, as a little bit of AI collateral damage, you might say, during really the first months of the first quarter, as I think a range of investors sort of have been, I would say, maybe groping a little bit in the dark for what are the implications of AI going to be. And, one is potentially going to be smaller sort of white collar workforces. And office REITs really became, I'd say, the vector through which some investors kind of were expressing that negative sentiment about the future, not necessarily of offices, but of white collar workforces, with office space being kind of the second derivative of that. So that's really created these tough conditions. I think that if you think there's going to be a continuing strong in-office workforce, particularly at the top of organizations, because what REITs are owning is typically going to be where sort of the management level is sitting in your central business areas, not necessarily sort of office parks where you might see back office activities taking place. I would say that there's a real contrarian position to be had right now with respect to office REITs.
We have another audience member.
So I'm going
Eric,
to give Eric a chance to agree or disagree.
Yeah, I would say I do very much agree with that. Really, it's all about sentiment, right? You have to separate the sentiment from the fundamentals. Fundamentals, to your point, are actually pretty good, believe it or not, particularly in New York office, particularly in some West Coast office markets. San Francisco has actually been recovering. It's coming from a very low period, but and some of that has actually been driven by demand from AI tenants. But what's captured the sentiment and has poisoned it for the moment or here, I guess, is this notion that AI is going to destroy all white collar jobs. Um, what we've seen in history over time, any new technology does exactly the opposite. While it creates disruption, ultimately it generates more jobs. We effectively become more productive. We don't do less with more, we do more with more. And so that's not what's the popular view right now. But to exactly your point, I think there are real good opportunities, particularly for new assets, for high quality assets, well located assets, which is exactly what the REITs own, and those in those technology markets. So I genuinely think the market's missing it here.
Eric, sticking with you, what do you consider to be the most important indicator of value in the REIT market? What should investors be looking at, investment managers be looking at?
Yeah, I mean, I wish there was one single indicator that would make my job a lot easier. We use implied cap rate as the North Star, but clearly net asset value, implied cap rate, very, very critical. That's something that we're very much focused on. And for those of you who don't know, although I suspect most of you do, that's the recurring cash flow yield effectively on the assets. AFFO, so the adjusted funds from operations, that measure is our core measure of growth in the industry, but with the capital added back in that's required to keep the assets generating income. Very important distinction between that and FFO. Certainly important. Discount to replacement cost is also very, very important for us. And then private market values versus REIT market values. The REIT market tends to lead the private market by 18 to 24 months because of the backward-looking nature of appraisals. But if you're looking at the transactions that are happening today, when you look at, you see that the REITs are trading at about a 5% on average discount to kind of where that forward net asset value is. So a lot of different factors to look at from a pure valuation metric standpoint. And then obviously, I guess, it's all the same things that any real estate investor would look at: quality of location, quality of management, quality of the financing, and so forth.
John, the Nareit recently did its annual outlook. One of the key themes is the dual divergences between REITs and private real estate, something we've talked about before, and also between REITs versus equities. Has anything changed during the first quarter, or are those holding steady?
Yeah, thanks, Mike. And yeah, that was kind of a key theme of ours coming into 2026, that public and private values have not really sort of converged since diverging in a pretty striking manner a few years ago as rates started to rise in 2022, and REITs priced in those higher rates almost immediately into kind of their effective cap rates, whereas we saw private appraisals take quite a long time to price that in. And in our view, still have not fully priced in a higher interest rate environment that could persist for quite some time. And so we still see this valuation gap between public and private real estate. As of the end of the year, sort of we still saw sort of well north of 100 basis points gap in effective cap rates between REITs and private real estate. And historically, that has created opportunity for REIT, sort of both absolute, very strong absolute performance as well as relative outperformance. Where we've seen some of the gap close is on the other side of the ledger, where we were also seeing a divergence with broader equities, and we've seen that divergence in terms of sort of forward multiples converge a bit. Not fully. We still think there's quite a bit of road to run, but versus where we stood at year end, which was actually a larger divergence than we had in 2020 during the onset of the COVID crisis, and not quite there, but definitely approaching levels we saw during the GFC back in 2007, 2008, but without the ability to really point to something that was really meaningfully holding back real estate. It was really more enthusiasm for other sectors of the economy, especially tech, that was driving that divergence. But the REIT outperformance this year has helped close that that gap, but we still think there's actually room to run, which is one of the reasons I'm continue to be pretty optimistic about where 2026 is heading for REITs.
Hmm. So, Eric, related question. A lot going on right now. A lot of different variables. All things considered, though, is now a good or a bad time to invest in publicly traded REITs?
Yeah, I have lots of thoughts on this one. First off, I would say I encourage investors to think about REITs more strategically than necessarily tactically. Okay, I think that very sincerely, they're an important part of any balanced portfolio. They offer income, they offer diversification, and as we're seeing now, the benefits of diversification can be really quite helpful. There's good predictability of earnings and so forth. So I sincerely believe they should always be a portion of one's portfolio. But tactically, today, I think is genuinely a good opportunity to upweight that weight in one's portfolio because of exactly what John just spoke to. The resetting of prices in the public real estate market happened immediately. And we're largely beyond, not more than largely, we're well beyond that reset situation. Relative to private market values, you're getting in at a better point today. You've got pretty good cash flow growth today, despite the noise around the world. Contractually guaranteed income in the form of leases is a pretty good place to be in a very uncertain world. And from a valuation perspective, relative to the broad equity market, and while earnings in the broad equity market can zig and zag and go negative very, very quickly, but also go positive very quickly, when we look at the relative earnings multiples of REITs on an AFFO basis versus the adjusted EPS for the S&P 500, what you find is that normally you have to pay a premium for the REITs. REITs have, in other words, have a higher multiple, usually about 2 turns higher. Today, you're actually getting them at about the same multiple. And so, to that value relative to stocks and other alternatives in one's portfolio, they look pretty good. And then lastly, they've got a 4% plus well-covered dividend, and that dividend yield is growing. So to the extent you need to find income, I think they offer a very competitive dividend.
John, we have a question about subsectors. One subsector that led all back in 2025 was healthcare REITs, and they are performing well in 2026. What's the dynamic in that sector? Is it simply the demographics of an aging population, or is there more at play?
Yeah, I mean, healthcare, especially senior housing, has really found itself in a great situation in terms of both supply and demand. On the demand side, I think that it's sort of this is a story that's been told for a long time about how the aging population is going to drive be a really important driver of demand into senior housing. I think that the one thing that happened was that some people sort of made this call sort of too early, kind of as the baby boomers were turning into their 70s and early and mid 70s. But whereas in the 80s is really that trigger point for senior housing. And what we're seeing now is that our 80 plus population, it's the fastest growing population cohort of the population in the U.S. And in fact, it's the expectations are that the 80 plus population will actually double between 2025 and 2045. So we are seeing those demand drivers really show up in serious measure. And added to that was really kind of I think a unique COVID impact, which was frankly starting in 2020, you just didn't see any supply coming online in senior housing, frankly, because it was a tough time for senior housing, and there were real concerns about occupancy, and in some ways the longer term impact COVID might have on that sector. Well, what we saw was that as sort of the COVID waves receded, we saw occupancy starting to come back up, recovering in that sector, and so that combination of a lack of supply plus the growth in demand has really, I think, set this sector up quite nicely, and set it up nicely, I think, in a longer term sense, because even now that we're post COVID, we're still not seeing tremendous amounts of supply coming online in this sector. And some of the things Eric pointed to earlier of higher construction costs, higher cost of inputs for construction, as well as issues that we see like NIMBYism, difficulty in zoning. Those all, I think, set up nicely for the existing owners of senior housing facilities.
Hmm. We have another audience member who is invoking the name of the great Sam Zell, who famously or infamously thought about replacement costs as one of the most important metrics in assessing acquisitions. And he's asking if anyone believes that that viewpoint is more or less valid today. And Eric, I, uh, you know, would ask that you not answer this in the same manner Sam Zell did. He was known for his profanity-laced speeches. Let's keep
I'll
it
do
GP 13. What
sure. Yeah, I'll do my
about
best.
Sam Zell's
Exactly.
prognostications
Yeah,
there?
I've
when
got
I
the
start talking
beeper
about
ready.
REITs, I do get excited, but I'll try to keep it PG-13, as you say. So replacement cost, yeah, absolutely. Replacement cost is critical. It is no less critical today than it has been at any point. In fact, if anything, it might even be more critical, because what it tells you is A, that you've got a good basis in the asset. B, that point about supply, that you're not going to be competing with much new supply, because if you can buy an asset for less than it costs to build, nobody would be crazy enough to build. And if, for the people on this call, I would say that if there's one thing that you need to look at, if you want to just kind of pay attention to real estate for 5 minutes every month or quarter, tune in to what's happening with new supply. Demand tends to be pretty steady, right? Outside of issues, short term, they tend to be. It's all really about that supply. And if we get too much supply, it hurts the real estate market. And more often than not, we don't have too much supply. And so if you're in a situation where assets are, trading below replacement cost, you are in a very good situation, not just today, but over the next 2, 3, 4, 5 years, because it's going to accrue to higher rent growth as a result of lower near-term supply, and you're not going to have your trade area kind of truncated by a new building that's being built.
John, anything to add there?
Yeah, I absolutely agree. I think, probably the only thing that has changed since sort of since Sam Zell was speaking about this, it is probably another dynamic, which is, just the difficulty in some sectors, but it feels like that the number of sectors that you would have citing or getting permits for a new property. We're seeing this, across an increasing number of sectors where, it's not just about having a potential advantage because or a moat, versus new supply because of replacement costs, but also even if replacement costs sort of would allow you to build a new property, you may have difficulty entering that market anyway. And so that's just another area that I think investors need to think about as they're thinking about what's going to change in those supply demand dynamics in a given submarket.
And Sam Zell was famous for selling his portfolio. He had a sense for when the market had topped out, sell off his portfolio, buy it back for a lot less than I don't want to say pennies on the dollar. It wasn't that cheap, but
Yeah.
he really knew how to pull that off. He was a master of timing. Um, when it comes to data centers, though, John, I'm not sure that. I mean, that's a very long track. It would appear, and data centers underperformed in 2025, and it was the worst performing sector of the index, but data centers are leading the REIT index this year, as you had showed
Yeah.
with your tables and charts. What's the story there? Why the fortunes turn very quickly, and data centers are just one of those property types that people feel can never be overbuilt. Maybe that is true, maybe it isn't. What say you?
Yeah, I think you definitely might get a little whiplash kind of looking at the year-to-year returns from last year to this year in terms of data centers. I actually think, in some sense, there was a little bit of a repricing for data centers last year after a couple very strong years of equity returns for REITs. I also think there was a little bit of, and I think I would describe this maybe more to sort of generalist investors and less to the REIT dedicated investor community, but a little bit of maybe a misreading of the REIT data center business model and risk profile. We saw REITs sort of trade off on REIT data centers trade off on concerns about how much hyperscale AI model training demand might be needed earlier in the year. That's a business that, the data center REITs are doing some development around that. That's not their core business today. Their core business today is really driven by more traditional cloud-based and computing services. And then we saw another sell-off of data centers based on, how much CapEx they were going to need, even though, the expectation is most of that CapEx, if not, is going to be quite accretive to earnings, not even over the particular long term, but really have very strong development returns. So I think in some ways, what we're seeing this year is a little bit of a reversion to what it would be more appropriate given their very, very strong operating performance. And what we may have seen was some sell-offs due to, like I said, it's a little bit of mischaracterization, misunderstanding of the business model. Some generalist investors sort of concerned about very near-term results, whereas I think the REIT dedicated community, the sort of traditional REIT investors, were a little more focused. And what we saw was, even despite REIT data center performance last year, we saw REIT active managers being significantly overweight. So I think we saw the REIT active managers looking through that noise, seeing that sometimes as a buying opportunity and adding more data centers to their portfolios.
Mhm. Eric, where do you stand on data centers?
Yeah, I would very much agree with everything that John said, and in fact, we like them quite a bit today. Your comment that they seem as though they can't be overbuilt, that is absolutely true today. It won't always be true, but it is true today. I think I would add on that to a bit, they were a bit of a victim of their own success. They had a strong 23, strong 24, and their portfolios were full. And so while they were growing well and they were, had very strong leasing activity, they didn't have a lot of new space to lease. They were kind of in this hole in the donut, so to speak, in terms of adding new capacity to the point that John made about needing to, put CapEx to work. And then at the same time, you had some of these kind of very big, huge scale projects, untested developers, I guess would be the only way I could really describe it, of pioneering locations. And those are of mega projects that really sucked a lot of the capital and excitement out of the traditional data center space to kind of this new neo cloud environment. Well, we've yet to see if that will ultimately work, or if that's these pioneering locations will really become competitive or not. But either way, what they're building is a different type of data center. And I know they all look like data centers to everybody. It's a big box with a lot of computers in it. But the type of connectivity within the box, the type of whether it's multi-tenant, single tenant, whether it's designed to train a large language model versus use a large language model, will be very, very different. It's our view that those big mega assets will be great for training large language models. But once the model is trained, there's not a lot of continual demand to build the next model or continue training it. The real step function becomes using that model, and that's going to be done in highly interconnected data centers that are much more the traditional mainstay of the data center REITs.
Mm-hmm. I just came across information that Texas is the location number one in data centers. I believe it was Virginia was number two, but Texas is number one. And location is so important with data centers these days because of the energy requirements and so on. So, John, let's talk about policy issues. Are there any policy issues looming right now that would be encouraging or discouraging or worrisome for REITs?
Yeah, I think it's a great question. I think it's important to keep in mind that, REITs have very broad-based, the REIT model, has very broad-based bipartisan support. It has since REITs were created in 1960. We've got 170 million Americans who have REITs in their portfolios somewhere. So I don't see it as a REIT issue or a REIT policy concern. What what we have seen is that as REITs, sort of have increasingly sort of owned the breadth of the economy uh, in economic activity. By I mean all the sectors that we've seen as new and emerging sectors, data centers, single family rental, healthcare, kind of the list goes on. REITs are really owning that breadth of economic activities. And so what we see is that as REITs are housing more of the economy, it's sort of more likely that as the activities in a particular sector become more sensitive or divisive, REITs end up being in the conversation in some way. I think a good example, recently we've got some legislation that's pending. There's differences between the House and the Senate. People don't know in where it's going to go, but that was restricting the ability of institutional investors to own single family rental properties. So importantly, not a REIT bill, not a bill that was aimed at REITs, but single family rental is a subsector of the residential space in the REIT markets. Not a gigantic sector of REITs. It's about 2% of REIT market cap, but sort of some really interesting, innovative REITs doing business in that sector, nevertheless, and they would be implicated in this bill. We've sort of been very clear with the administration, with Congress, that we don't think if the goal is to increase housing supply, that restricting the ability of institutional investors, including REITs, to own single family rental properties, where they also do a lot of development and bring a lot of supply online, is particularly productive towards that end. So, lengthy answer, I would say not risks to the REIT model, but we will continue to see REITs owning properties in sectors that have become part of the political discussion or discourse for various reasons, because they are owning that breadth of structures that house economic activity. And it's
Well,
something as Nareit we spend a lot of time on. We spend a lot of time on it, so it's something near and dear to our hearts.
yeah, the build to rent sector is actually adding to the housing supply, so it would seem that they should be immune from this. But I've heard that the administration is talking about you need to sell the properties off within what, 5 to 7 years, something like that. Eric, are you up to speed on this one?
Yeah, yeah. So as it looks right now, it would be they would need to sell any build-to-rent properties after 7 years. Still, as John pointed out, differences between the House and the Senate version and whether it ultimately passes. From my opinion, is a clearly counterproductive legislation to the aims that they're trying to achieve, which is housing affordability. The only path to housing for affordability is simple. It's more homes. And this actually does the opposite. Any restrictions on single family owners, institutional or otherwise, hurts the overall market. It will cause capital to leave that market and ultimately result in less new supply, not more new supply. Um, this is really about, in my opinion, a fix. Maybe I shouldn't say this, but I'm going to. A fixing blame, not fixing the problem. And so it's popular for to Wall Street to be beaten down, and it's kind of viewed as a negative, bad guy here and causing problems on Main Street. In fact, they even named it stopping Wall Street from competing with Main Street, as at least that's what the president's executive order was called. Um, but what they've missed is the fact that the REITs in particular, and even the other large institutions, have shifted, and for many years now, shifted their strategy away from buying homes, particularly one-off basis. It's not particularly efficient, to this build for rent model. And to the extent that this throws a spanner in the works of that, all we're going to get is fewer new homes built. Home builders can build these projects and know that there is a buyer on the other side. That lowers their cost, their risks. And to the extent you take that away or you require them to be sold after a short period of time, it's just going to result in less new building. And that's the only solution to this.
Yeah, what's interesting is Steven Schwartzman, the CEO of Blackstone, is in that business, a major contributor to the Trump administration or the Trump campaign. And I'm sure he's feeling a little bit kneecapped right now. depending on how this whole thing turns out. And I have another question from an audience member who's pointing out that companies are waiting longer to go public. Is this also the case in the REIT sector? I will just point out I just read an article in The Economist called "Making IPOs Great Again," and it appears there's a real movement to make the process less onerous, so that more companies will choose to go public. And we do have some big company. Anthropic's going public, SpaceX is going public. Um, who else am I leaving out? OpenAI is looking to go public, so some really big IPOs may be in the offing. But what about with respect to the REIT sector? Um, John, what do you say?
I mean, we've definitely seen, pretty slow pace of IPOs over the last couple of years. I mean, I think that's been more driven by valuations than anything else. We did see Lineage Logistics go public in 2024. That was the largest IPO of the year across any sector, and one of the largest REIT IPOs in history. And sort of has been a very welcome addition, I think, to the REIT investing space to have be a second cold storage REIT in the investing space. That's it. I mean, I think that we've definitely seen some cases of companies that considered going public, and then ended up with a private takeout offer that ended up being the preferred route. But when we look over kind of the longer span of history, we have seen a pretty steady pace of IPOs over time, so that the number of public REITs has been surprisingly stable when you look over a 20-25 year period. So, I definitely think some of the things that have driven more activity into the private space for public companies generally certainly apply to REITs. I would describe more of the dearth of IPOs over the last couple of years as being valuation driven rather than sort of broad structural concerns. And my expectation is when we see REIT valuations kind of recover versus private markets and broader equities, that there are probably some interesting business models waiting in the wings to come out in the IPO market, and some private portfolios that would like to find liquidity and may find it in the public market.
Yes, yeah. So, Eric, we have another audience member question. He writes, with heightened volatility and rising recession concerns, are REIT managers becoming more defensive in their portfolio posture? What do you think?
Well, I can't speak for my peers, but I would say that we certainly are. We have been defending the portfolio, as I like to describe it, against a number of fronts over the last many years. It was first the prospect of higher inflation, then it was higher interest rates, and now it is, both of those, frankly, at the same time, with the potential for the remote stagflation today. And one of the ways that we do that is in terms of kind of tilting the portfolio towards sectors that we like, away from more expensive sectors, changing the leverage profile of the underlying companies that we own, small cap, large cap, quality, and so forth. So we have a lot of levers that we can employ to do exactly that. And I suspect my peers are doing the same sorts of things, but we certainly have gotten more conservative, I guess would be the way to describe it.
Hmm. So, what about John? I'll have you lead with this one, and then Eric, have you weigh in. What about some of the more attractive property types or sectors that you see today? What maybe you can name two or three that you would say, John, are green flagged, and maybe a couple that are red flagged.
Yeah, and I'm gonna duck this a little bit and really put the pressure on Eric by I'm gonna
And I know why.
a lot of times I give my view, but I thought I had a feeling this question was coming, and I thought let me instead tell you who's overweight in our REIT active manager tracker. This is a analysis we do on a quarterly basis, and I'm very very curious to see how Q1 works out. The data are still in process, but as of the end of the year, we saw active managers overweight in healthcare. No surprise there. Data centers. No surprise there. Residential. Even though they had brought their weight in residential down pretty significantly over the prior year, but still on a net basis overweight versus the index. And the telecom sector, the cell phone towers, which I think has had a rough couple of years, but I think a lot of people were viewing kind of the light being at the end of the tunnel with respect to at least demand uncertainty. With underweights in residential and industrial, and actually about neutral at office, even though office is now just 3 to 4% of the index. And I would say that when I look across that space, the only one that really kind of makes me scratch my head a little bit is retail, where I view especially strip center retail, and I mean the malls are in terms of demand seem like they're doing great. And strip center retail to me just seems like it has tremendous upside. But that's sort of the broader view of where the broad set of active managers are. And I'll kick it to Eric to tell me
Yeah.
where they're wrong and where I'm wrong.
Yeah, it's always interesting to hear what other people seem to
Yeah.
be, where the consensus lies, I guess. First off, I would say, we agree with a lot, right, in terms of data centers and seniors housing, as we've talked about for all the reasons
Yeah.
that we've been talking about today. Strip centers, different subsector within retail, is a sector that we like quite a bit today. You've got very good starting values, you got high yields, you got very solid cash flow, you got very stable tenant bases. And I think what's happened in retail most recently is people have kind of just bucketed it all together and are not appreciating the nuances and the differences of a demand for grocery anchored shopping center with a pizza parlor and a liquor store and a haircutter and a nail place, sorts of things that people go to continually, regardless of the environment, that you need to do in person. There's a lot of essential services at these dentists and so forth, versus kind of the regional mall fashion oriented type of tenancy that, while those are also performing well today, are more likely in a recession, consumer driven pullback to see their tenants suffer the most. So we very much like that shopping center space today. From a, sometimes you have to separate values and fundamentals. So in the industrial space, for example, we find that while the fundamentals are pretty good, they're deteriorating a little bit. You've got a little bit of a negative second derivative, but still very strong absolute performance, and potentially that might be shifting here. But we find that that's already priced. And so from a value perspective, we find those stocks to be too expensive. Office is someplace where we actually, this pullback is likely to kind of persist for a little while, just given the narrative until that narrative changes. But we like the values where they sit today because of that pullback specifically. And then I would just say in self-storage, there's another sector that you didn't mention. Fundamentals are kind of weak, sort of the opposite of the traditional industrial sector, but the valuations are actually quite attractive, we see. So, we're always focused not just on where the fundamentals are, but where the fundamentals are going. But most importantly, how is that valued? How's it valued relative to the opportunity set, relative to private market, relative to replacement cost, and so forth. So those are some of the things that we like quite a bit.
You mentioned self-storage, and one of our audience members said, have you seen self-storage performance benefit from demographic trends like aging population, young professionals living at home longer, or the residential lock-in effect, and so on? I did recently do a podcast with an operator, a self-storage operator, who said it's the five Ds: death, divorce, dislocation, downsizing, and decluttering. Any thoughts on that, Eric?
Yeah, those are the primary drivers. There's no doubt about that. What I would say is, housing market, like nobody's expecting much of a turnaround there, right? So it's all about that turnover in the housing market, changing, moving from one place to another place, one apartment to another apartment. It doesn't have to be a home that you buy or sell. And that generates a lot of demand. But right now, and that's one of the reasons I think that the market's kind of just fundamentally bouncing along the bottom here. There has been a little bit of supply, not a lot, but a little bit more than certainly other sectors added over the last 5 years in the self-storage space. When we went through that last major disruption in our lives 6 years ago, called COVID, right? Everybody cleaned out that spare bedroom that they might have had, their garage, to make space for everything else. And they ended up, to make space for their home office, putting that in a self-storage locker. And so that created a real surge in demand. There was a small supply response to that. We got a little bit more supply. They're not easy to build, but they're easier than, they don't have any plumbing and so forth. They're easier assets to build than some other types of assets. And so the supply comes on a little bit more quickly. But at the end of the day, it's kind of these normal sort of life events. And perversely, in a topsy-turvy economy, it's a pretty cheap option. If you lose your job and you need to move from one side of the country to the other, rather than having to throw your stuff away before you figure out exactly what it is, $100, $300 a month for a storage locker is a pretty cheap option for you. And so, unfortunately, in more volatile times, demand actually can pick up a little bit. To the extent we ever do get a resurgence in the housing market, I think that's really additive. But to my valuation point, investors, in our opinion, are not paying for any housing recovery assumption in the valuations of where these self-storage REITs are playing today.
John, we have seen, it seems over and over again, these comparisons of active versus passive fund management. And this comes from an audience member. I'm kind of intuiting a little bit of this from the question, but passive management seems to outperform over and over again. With REITs, you have, correct me if I'm wrong, John, but I look at REITs and I think that's active management. I don't know if there's even an option among REITs for passive management. I'm not sure what that would look like, but what about the active versus passive argument?
Yeah, it's something we've looked at, and obviously there's sort of some of the big share there are large REIT ETFs, and lots of folks sort of use the passive approach especially in sort of the DC plans and sort of some generalists. One of the things we've found is that the advantage to active in REITs, which really does distinguish it from broader equities, where it's hard to find alpha generation after fees from active management. In REITs, we actually find really significant alpha generation or returns after fees. We did a study with a research partner called CM Benchmarking, where they looked at this out of U.S. pension funds, and what they found was, on average, active management was beating passive management by 34 basis points per year after fees. So, really, very, very significant gains to active management. And I think that there's some good reasons for that. One is, I think that sort of the REIT active management community, Eric's, I think, a great example, right? They understand equities, but they also understand real estate. They're looking at real estate supply demand fundamentals, and they're often trading against, in a way, generalist investors who may not be looking at those fundamentals. And I think that creates real opportunities for alpha generation. I think the data center experience of last year, I think, is a perfect example of where you've got some maybe very short-term oriented generalist investors trading out of a REIT stock, while active managers are saying the fundamentals of this company and the sector this company operates in are tremendously good. And if if the share price is going to fall by 5 or 10% on a day because generalists are trading out, I'm more than happy to add that to my portfolio. And if you do that enough, you will see alpha generation or gains to active management. So I've actually become, the data has made me a real believer in the value of REIT active management.
Mm-hmm.
And I'd say
Eric,
that even if Eric wasn't here. So,
well, thank you. And of course, I have a few thoughts on this. I would say REITs are, to exactly John's point, a less understood corner of the financial markets, and that makes for ample opportunity to outperform, much more so than kind of large cap stocks or more kind of mainstream segments. And it's its own asset class, but because it's priced in the public markets, there's a lot of investors, frankly, that don't understand REITs, that see them all the same and don't quite understand the differences in quality or region, or the difference between one type of data center and another. type of data center, and that creates huge opportunities. And clearly the data that John has referenced there, would vindicate my peers, and I would encourage everybody to look at our track record for kind of that consistent ability to extract value from the market.
Eric, let me stick with you on the question of global versus U.S. We came into this year and there's a lot of talk about European stocks are the way to go this year. A lot has happened since then already. Europe's getting hit hard by the energy pricing situation. But if we take this down to the REIT level, where do you stand in terms of global REITs being within the portfolio versus U.S. REITs, or not necessarily versus, it doesn't have to be exclusionary, but what would the balance be if you were in favor of both?
Sure. So we get this question quite often. As you probably well know, we have a big REIT manager. About half of our capital is global mandates, and about half of it is kind of U.S. mandates, roughly speaking. And it depends upon a lot of different factors, right? Very often, it's a function of where the capital is coming from. So what's the source of the capital? We have a lot of international sovereign wealth funds and so forth, overseas investors that are much more comfortable with global REITs. U.S. investors tend to be a little bit more U.S. focused, but not exclusively. We have plenty of U.S. investors who are also looking kind of globally. What it tends to come down to is what are their, how are their, and I should mention, we're mostly an institutional investor. We have the vast majority of our capital are big state funds, city funds, county funds, sovereign wealth, corporates, and so forth. It comes down to where their liabilities lay. And so when they have international exposure elsewhere within their pension fund, they tend to lean towards global. And if they have US only liabilities, they tend to lean towards US. Where the opportunity set lies, back to my question about kind of tactical versus strategic, I would encourage everybody to think strategically rather than tactically. But I do think today, tactically, you've got a pretty good opportunity in the US, where you don't have to kind of assume a lot of currency risk and whatnot. So as a US investor, I would counsel you today to probably sit in US REITs. Global outperformed a little bit last year. It depends whether or not you're measuring it in US dollars or in local currency terms. But this narrative that global investors are pulling capital out of the US, I think is oversold. It's not what we're seeing. And I think that you kind of have an opportunity today to actually kind of outperform in US REITs. The other surprising thing is in terms of global REITs, what people tend to, I think, naturally think of them is higher risk, because they're looking at it from the perspective of a US investor. But it's actually a bigger universe. And as a result, it results in a little bit less volatility, because Japan might, offset some, the decline in Japan might be offset by a rise in Canada or South Korea or Australia and so forth. And so the actual return volatility of the overall market is actually lower, but at the same time, slightly. But also the return is a little bit lower. So you get less volatility for the same unit of return overseas than you do in the US.
Okay, we have just about 90 seconds left, so I want each of you to offer your outlook for the REIT market during 2026 and why. John, why don't you lead off?
Yeah, I mean, I think I'm going to, conditional on us seeing a sort of a quick end to sort of geopolitical conflict. I'm very bullish on REITs this year for all the reasons we talked about, of the divergences, the strong operating performance, and we didn't talk much about balance sheets, but REITs came into the year and have maintained really strong balance sheets. I think even if we do see a macro slowdown, I still think relative REIT performance will be quite good for those same reasons, although we may see absolute performance come down a bit.
I would just say we're counseling our investors to expect over the next 12 to 18 months returns in that 8 to 12% kind of range. I think we can easily get there, and we can get there without any multiple expansion. You've got a 4% dividend yield. You marry that to 6% earnings growth, which is what we expect in 2026, and it should be accelerating a little bit in 2027 based on consensus earnings. You've got, as I mentioned earlier, a 5 to 6% discount to net asset value. And so you can very easily get to that, 10% to 12% kind of return. And just assuming that maybe, we even take a little bit of a step backwards, that kind of gets to that bottom of that range. So we feel very comfortable with that 8 to 12% return without any leap of faith of things changing over the next, from this point forward. So it's not as though the 4 or 6% we're up now year to date would subtract from that.
Mm-hmm. Well, our time is up. John Worth of Nareit and Eric Rothman of CenterSquare Investment Management, we thank you for your sharing your data, your insights, and to our audience members, we thank you for your attendance and participation. Please note that our next REIT webinar is scheduled for July 14th. Keep an eye out for that publicity and registration information. We hope to see you there. On behalf of IREI and Real Assets Advisor Magazine, this is Mike Consol wishing you a good day and a great second quarter of 2026.